Well, hello and welcome to Global Mantra Market Outlook 2015, a special series that we bring to you from the City of London, speaking to a lot of prominent fund managers and market speakers about their outlook into the new year. My guest today on the show is Virginie Maisonneuve, who's CIO Equities at PIMCO. Virginie, it's great to have you on the show. Thanks very much for taking out the time. You know, my first question to you is really what's in store for 2015 as you see the story for now. 2014 was a year when most fund managers were overweight equities. How do you see the equity story panning out for the new year?
Well, I think you'll continue to have a supportive backdrop for equities because we see the world at PIMCO is, on a secular basis as being the new neutral, meaning low growth, low inflation, and lower real rates that would have been the case in years prior the crisis. That environment is actually very positive for equities because you have a lower real rate environment. So you could say the competition from the bank account or interest rates is still very low, even if you have the beginning of a normalization of rates in the US. It's going to be very slow. So I think in that environment, that's very positive. People should own equity. However, it is not a beta play. You should not just buy the index. The re-rating, from the lows of 2009 has taken place. You're now in an environment where you have fair valuations across the world. Some areas are cheaper than others. So if you look at Japan, for example, valuation now for first time in many years is below the US. Europe is still quite cheap, but those areas clearly are encountering some challenges. The US clearly is more expensive, but the US economy is getting much more traction than the rest of the world in general. And then when you look at the world of emerging markets, you also have very different pictures if you look at India and China versus Brazil and Eastern Europe. So all of that means that the valuation support is very important, but the growth drivers is key in this low growth world.
So keeping that in mind, keeping that growth is largely going to drive flows to any particular market, which markets are you betting on? Because the US has had a great year, and this has been on the back of a great 2013 as well for the US, right? Yeah. So where does money flow from an earnings perspective, which would be supportive of valuations for a lot of these markets?
So I think, again, in the world of equities, and particularly if you go back to the new neutral, it's not only about countries and region, it's also about style, which is what is very important to understand. If you go back to what I've just said about it not being a beta play, but being an alpha play, you want to really think about how you gain exposure to the markets through the style. And then each of those style will have a different ways to look at the regions, and then they'll have different exposure. So let me take you through that first. In a world of low interest rates, people will want income, will continue to want income. And in that environment, we at PIMCO have a very good strategy called the dividend equity strategy. We also have a hybrid product, fixed income and dividend. The dividend strategy is finding a lot of attractive stocks in the US still because of the strong cash flow element, the buyback and the dividend element. That doesn't mean that they don't find interesting names in Europe. They actually like the European financials, for example, but on an ACWE basis, they underweight emerging markets. So that's one way. The second bucket that I think you need to really have is a growth bucket, because in a world where growth is very slow, stocks who can give you some growth are going to be re-rated. So if you think of emerging markets as a growth bucket, within that, in our products currently, we are definitely underweight Russia and EMEA in general. Things are very difficult there in terms of the equity space. Credit space might be different, but the equity space is being challenged. You're having challenging oil prices, which clearly is very difficult for some of the producing countries, but also other issues such as geopolitical issues around Ukraine and also the impact from the Middle East. On the other hand, if we look at Asia, we like the consumer in Asia, we like India and China in particular, but also even in an emerging market context, we like Taiwan, we like Hong Kong, the Chinese part of Hong Kong, And we also like the Japanese companies who are actually benefiting from the emerging market growth, particularly in automation, for example. Now, the third bucket I think that you need to be exposed to is to protect you on the downside, because although I see 2015 as a year that's very constructive for equities, I continue to see air pockets. And what I call air pockets is this sudden risk shift that we can see, as you have seen with Russia around Ukraine, in the Middle East, or unexpected events that the markets is taking, the markets are taking in a negative way, and then they realize things are fine and markets come back. So air pockets are good. They give you an option to buy, but you want to be protected in those markets. So with this in mind, you want to have a long-short sort of strategy, because you benefit from the air pockets on the short side. But you also want to have a value strategy with the defensive characteristics. So contrarian value, if you want, where people will say, when you have this sudden drawdown in some stocks, we can buy this. We will buy this because we see a long-term time horizon and take advantage of those.
Okay, let's talk about Europe then, because that's one area which has not had a great 2014.
Yes.
Do you see a contrarian story there for 2015?
I see. Yes. So I think in Europe, again, as stock pickers, you have to really, understand what is your style getting you to. So in the case of our value strategy, that value strategy called Pathfinder is overweight Europe. Okay. So in Europe, it's finding the attractive areas, and the portfolio manager in that area still likes staples very much. But you also see a lot of attractive valuation in the financials. If you believe that QE is going to come in Europe, those stocks could be very well placed to benefit from that. The other thing you have in Europe that we like is that, given the multi-speed world that we are seeing now, and the impact on currencies, i.e. a strong dollar, a weak yen and a weak euro, you have quite a large portion of the European-based companies who are exporting to the US. So if you think of healthcare names, for example, they would benefit very much from a recovering US and a strong currency.
Okay, so give us a sense of how you see the risks coming in out of Europe impacting the equity story world over, even for the US markets as well as emerging markets. You're saying that Europe could be a contrarian story. How do you then, rationalize the risk of deflation, possible recession in Europe? You think that if a QE is announced in Q1 or Q2 of the year, that would pretty much, in a way, mitigate the downside to these markets?
So I'm looking at it from a stock perspective, an equity perspective. I'm not making a top-down macro forecast, but what I'm saying is, if the economic news is negative, the chances of a QE is higher, and the stock market anticipates that. And so you will have a move in the market before the impact of the QE actually takes place. Do you see? So a bit similarly in Japan. Japan is an area that I think is quite interesting, but again, different fundamental equities team in my group will do different things, and that's completely fine depending on the style. But if you think of Japan as an area that could really benefit from a competitiveness standpoint from the weak yen, and also from the fact that it imports most of its energy now, and the weak oil prices, which I think is a factor you must really think about from a thematic standpoint, can help Japan. You also have some very interesting companies in Japan that could be contrarian plays.
The other aspect is, the Bank of Japan has, pretty much induced a lot of liquidity into the market. You're expecting that to happen via the ECB as well next year. how much of this money, and your broad view on emerging markets is slightly on the bearish side, but how much of this money would actually fuel emerging markets?
Well, I think it depends, and I am not bearish emerging markets. Different teams on my platform will have different positions,
Sure.
but clearly on a longer term basis, I like emerging markets very much. I think 60% of world GDP comes from consumer. The emergence of the middle class in emerging markets over the next 30 years is still a very strong concept. And in our emerging market portfolios, we're very overweight consumer. We really like that. So, but what you're saying is, how does QE and potentially the normalization of rates in the US, how would that impact emerging markets? And I think we need to think about talking of emerging markets differently. They're not one group anymore, right? Clearly. So you have, the China bloc, where actually China is sort of isolated because of currency control, capital control, etc. And there the major factor is going to be the through train and the bottoming of the economy. So we're not talking about 7% growth for next year for China. That's very good. It doesn't have to be higher. That's positive. Now on the other hand, the strength of the dollar, as you will know, is actually putting a downward effect on commodities, including energy, but not only energy. That is not very positive for countries like Brazil or other energy producing countries. That doesn't mean you should not buy them. What it means is, again, you have this as a backdrop, and you have to really monitor the valuation of those stocks, because at some points, even stocks involved in those sectors, in those countries, will become very cheap, and you'll want to buy them. So it's a different things. Now, the tapering effect that we had, the fear of last year, I think will not happen. Okay. Because people have talked for so long now about slowly rising rates in the US.
The markets are prepared.
I think so. I think if we had a very sharp increase of rates versus what is expected, which is not the case of you at PIMCO, that might derail some of the stories, but otherwise I think it's pretty much there. Okay. But what you want to do in emerging market is make sure that you invest in solid countries, where the fiscal and budgets, etc., are in a good position.
Talking about the dollar rally.
Yes.
Now, I was talking to some of my friends in the fund industry, and they believe that the dollar rally can be the big headline for 2015, and can put a lot of pressure on emerging market currencies. Of course, there'll be an export side, which perhaps might get a boost on account of that. But the dollar rally can be the big talking point. What do you see on what happens to the dollar?
So that's exactly why I'm saying it's not about beta, it's about alpha. Because you're right, the beta as markets overall will be impacted by that. And if you think that 70% of all transactions in the world take place in dollar, that dollar strength has a pretty big impact on the global economy. So, but what matters is selecting stocks. That's why it's about alpha. You can find stocks in every one of those countries who can benefit from different factors. Can benefit from strength of the dollar if they're exporting there or their currency is weaker. Can benefit from the falling energy or commodities prices if they're using that as an input and then say re-exporting, for example, or their consumer are getting a relief because they're paying less, energy. So it's not as simple as that. The second thing I want to say is you can always hedge the currency and try to extract the return of the stock and try to mitigate the currency impact.
Also, a function of the dollar rally is, of course, the rate differential, right? And a big part of that story is, when do rates go up in the US? What's PIMCO's view on that?
So we're still in the view that, mid-year 2016 should be the time, but clearly things can change.
You don't think 2015 we could see a rate hike?
2015, sorry. I'm a year, 2015,
okay.
Mid-year
no, that's
2015.
That's not entirely from the realms of
know.
speculation, because I've spoken to a few market speakers who do believe that maybe rate hikes would not be a story for 2015.
I think it's a possibility, but the house view is still that, it's a mid-15 view.
And do you think the response of the markets would be a calibrated one to that, or do you think it could be something like May 2013 where the markets could, sell off?
I think the markets would sell off if we had a very sharp increase in rates in the US, while the rest of the world is still in a very difficult stage. I think that would be very negative for the equity market, because it would mean that the US is the multi-speed world, as I call it.
And sharp increase would mean increasing rates quickly or increasing a big
both size and speed that is beyond current expectations, if the rest of the world was very weak still, because that polarization could have consequences that I think people have not thought about. I think a very gradual paced increase that's well televised or messaged, will be fine.
And when you're talking about a more measured move by the Fed on that front, what is the base case scenario? 25 basis points hike mid-year through 2015?
This is it, but again, this is something that we're always reviewing, but this is the base case.
Okay, what about valuations in the US? Let's talk about that. You've spoken about alpha opportunities there. Where is it that you're seeing opportunity in the US from a value perspective? I mean, the S&P 500 is above 2,000. 19, 20 times. They're nowhere close to the crisis valuations, but what's the headroom?
So I still like the consumer. I still like consumer stocks there. And, I can't give you names because our media, but I still like the consumer. I like some of the industrials. I like technology.
Don't you think valuations in technology are signaling somewhat?
I think it depends on the stocks that you're looking at. And I think it depends also if you're starting a new holding or if you already have a holding where you can be very cognizant of valuation and trimming and adding when you have air pockets, which is really what I think the policy is. You find those names that you like, those core names, and then you have a position in them. When they go a bit too far, you think they're closer to fair market value, you trim. When you have air pocket or fear in the market around some event, you add back. I think that's the key. So you have to spend your time on identifying those franchises that you think are really worth having in the portfolio on a longer term basis.
Do you think that the US right now is in a secular bull run, or are people still talking about the rally as a cyclical one?
I think the underpinning for the US economy is very strong. There's a lot of competitive reasons for that. Demographic reasons, energy reasons, on the path, with the energy self-sufficiency, innovation. There's a lot of very good things going on for the US. However, the valuation of the markets means that you will have air pockets. And so I think about it as having, a long-term view, a secular view that's positive, but you need to be very valuation conscious and be very tight with your fair market values and not be shy to take profits when you see it, because otherwise it can be quite painful.
Okay, what about India then? And I'm straight coming down from the US to India, because that's the other market which has had a fantastic year. Individually, it's it's a lot about the US, but it's also been a lot about India, just the way the market stands out in emerging markets. Is it hard to think about risks that can derail the India story right now?
Well, there's a risk of the lack of implementation of the proper policies or a delay, which is what you really want to look at. Now, from a bottom-up standpoint, we still like the holdings we have there. We've trimmed a little bit of them because they've done really well, but we still overweight India. And we think that, you know, again, the power of demographics, the power of reform put together means that there's still a lot of profit growth to have in India.
And which pockets are you looking at within India? Because, you know, India, at least in the last 3 to 6 months, ever since the new government has come in, it's largely being debated as either a consumer story, because there's going to be so much done. There's going to be the implementation of GST, which is going to be, you know, streamlining the distribution process, helping consumer companies. Exporters, with the currency being where it is, it's done better than other emerging market currencies despite a stronger dollar. And then, of course, the whole infrastructure thrust, you know, how we are on the brink of a recovery in the infrastructure cycle, which could be very strong. So, you know, in terms of sectors, where is it that you focus?
So we still like the financials as a way to play the economy. And we like the car industry, you know, with a lot of really strong underpinning for growth. In terms of infrastructure, it's been a little bit harder for us to find really good stock opportunities at a reasonable price. So we're watching it, but
India is a buy on dips market for you?
Definitely.
Oh, definitely. Okay. And you know, from in terms of policy expectations, anything specific that you hope to hear from the government over the next you know, 6 to 8 months?
Delivery.
Okay.
Peaceful, paced delivery of what was said. It's the sustainability and the repeatability of not only designing policy but also implementing them. That is what people want to see. Focus, delivering over the years in a very measured way, that's very important.
What about a ratings upgrade from India? You think that can meaningfully change your allocation to the region?
Not, because my allocation to the region would come from the bottom up. So what the teams and I will do is, you know, whatever the environment is, we clearly are aware of, you know, although we're stock pickers, we pick stocks within a coherent macroeconomic and secular framework. So what is the growth? What is the inflation? The cost, you know, of debt clearly is linked to rating. So that will have an impact. But it would not be a top-down decision. It would be which company is rightly priced that would benefit, you know, on the margin. That's how we build our portfolios.
So, as you know, as we kind of come towards the close of this interview, just wanted to get a sense from you on your top 3 equity ideas for 2015.
So I think the top ideas for 2015, I think China will continue to do well. I think it will be fine. I think people are underweight China. And it's an environment of stabilization, so I think that will be good. I think India will continue to do well, and I think industrials could rebound in this environment.
Okay, great. Okay. Virginie, we leave it at that. Thanks very much for taking the time and speaking with us.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.